Good day, everyone. It's David Paul speaking. Welcome to the last video of our 8 Vital Tips for Stock Market Trading Success series. And over the last few videos, video number 1, I've talked about tip 1 to 3, which was all about risk and position sizing. In video number 2, I talked about tip 4, which was how to manage the trade and, very importantly, not allowing winners to turn into losers. In video number 3, I spoke about tip number 5, which was how to focus on trading in the very best shares. Those shares that are growing their earnings safely, those shares that are undervalued. And in the last video, tip number 6, I talked about how to combine both technical analysis and fundamental analysis, how to focus on those shares where the fundamentals are great, the share is growing earnings safely, and that is in the throes of a trend with little volatility. The share is doing what we want it to do. And in this video, tip number 7, I'm going to talk about how never to buck the trend of the overall market. Before we get there, that's me, in case you've forgotten. David Paul. I've been trading in markets since October 1982. And that's what we're going to chat about today. Tip number 7, never buck the trend of the overall market. Now, there's a great time to be in the stock market, ladies and gentlemen, and there's an awful time to be in the stock market. And that's been brought home to us very plainly over the last month or two, where October, November, December was not a good time to be in the stock market. But January, February, and now into March has been a great time to be in the stock market. And we need a simple and an objective way to tell us when it's safe to be in the stock market. And the founder of VectorVest, Dr. Bart Toledo, puts it really well when he says that the most important thing to know is whether the market is rising or falling. Everything follows from that. And that puts what I'm going to try and get across in tip number 7 very clearly. So why? Well, first of all, there is a whole industry out there that tells us to ignore market direction. My father tells me, or told me, should I say, that when the UK market made a high in 1969, it took 21 years in real money for the market to break up through that 1969 high. So buy and hold is wonderful, folks, if you've got a few years to wait. I think that buy and hold is very much, and the stock market itself is very much like this fairground roller coaster. It takes many, many years to get up there, but it falls very, very quickly indeed. And as I said, there's a whole industry out there that tell you that buy and hold is the only way to go. But just look at the chart. And if I can get my little pen back again, I've lived through every little bit of this. In this run-up into 2000, my word, that was a great time to be in the stock market. There was shares going from, in the US, from $1 to $100, an incredible time to be in the stock market. And then, of course, we had the sell-off from 2000 to 2003. And then we had this run-up, pushed by commodities up into 2008, 2007, 2008. And then, as we all know, it all fell apart. And now we're in the throes of this bull market, which is still running. This was not a good time, folks, to be in the stock market. And as I say, we need some form of objective method of working out where it's safe to be in the market and when it's not. Now, you can use moving averages. Moving averages are not bad for the entry signal because markets, as I say, like the old fairground roller coaster, markets move up relatively slowly. But moving averages are not great on the downside because they're lagged and the markets tend to move very fast on the downside. So just be careful about that. In 2008, the average mutual fund fell by over 40%. The S&P was down pretty much the same figure, and if you're down 40%, you've got to do an awful lot of fancy footwork to get that back again. And of course, many people have never got it back again because they got such a scare in 2007 and 2008 that they're still 10 years later largely sitting in cash. So at VectorVest, I go into the program now, we have got an objective method of measuring. And if I go to the home page of VectorVest, on the home page of VectorVest, we've got two words here that define the trend position with no chart reading at all. And as I record this video on the 18th of March, 2019, the trend situation, I think hopefully you can see, is up and up. And that means, folks, that the primary wave or the short-term trend is up and the underlying trend is up. And our most conservative measure of the market, which is called a confirmed up, which is the underlying trend confirmed by price action, is on a positive note. And all of this is summarized on the front page of VectorVest. No chart reading is required, and it tells you exactly what to do here. VectorVest advocates buying safe, undervalued stocks that are rising in price at this time. Good place to be in the market, and this of course is shown via the color guard here, and as you would expect, green is good. Now, for those of you that like charts, well, you can pull up the market timing chart, which is a chart of all of the 2,200 shares that we follow in the UK. So it's a much broader measure of the market than the FTSE 100, the FTSE 250, all of the shares that we follow. And this is a candlestick plot over the last 6 months. And down below the price, we have our market timing indicator. Now, the market timing indicator is a rate of change of two things. It's a rate of change of the price of the VectorVest composite, that's the candle plot, and the rate of change of the proprietary buy-sell ratio. Now, every day, VectorVest puts a buy recommendation, a hold recommendation, and a sell recommendation to every share in the London stock market and on AIM. And we keep a tally of the number of shares on a buy divided by the number of shares on a sell. And that's our proprietary measure of the breadth of the advance. So in the market timing indicator, it's a composite indicator which combines the rate of change of the price and the rate of change of the breadth of the market. And when that moves above 1, the MTI moves above 1, the underlying trend is up. And when the market has moved for 2 weeks in a row, that underlying trend is confirmed by price action, as it was here. And on the 9th of January, ladies and gentlemen, our longest term measure of the trend on the London stock market turned up. And as I record this video on the 18th of March, it's still up. But for those of you that want to look at charts, it's all there. For those of you that are on the go, all of this is summarized on the front page of VectorVest. It's a completely and utterly objective method of working out the trend of the London stock market. And as Dr. Toledo said, everything follows from that. And that is tip number 7, folks. I believe, therefore it's true for me, that working out whether the market is rising or falling is 70% of the exercise. And it's vital that you know when it's safe to be in the stock market and when it's not. And VectorVest will show you how to do that objectively with little effort. And I don't care how busy you are, all of this is summarized on the front page of the app on your smartphone. And I don't care how busy you are, everybody's got a second to have a look at that every day, I think. Okay, now, the last tip, we go back to the PowerPoint presentation. The last tip is to trade and invest in liquid shares. Ladies and gentlemen, if you can't easily exit, then it's difficult to practice risk management. In other words, you may buy a share at £10 and you may put a stop loss either on a system or in your mind at £8.50. But if there's no bids at £8.50, you're not going to get filled, and the next bid might be at £6. So on VectorVest, in our uni searches, we can assign a volume traded figure, and a very useful measure of that is to assign an average daily volume over the last 50 days of at least 100,000 shares, and this can be added as a line into any uni search to eliminate shares with poor liquidity. So tip number 8 is always trade in shares with good liquidity in relation to your position. And there's no doubt about that. As your account size gets bigger, then there will be shares that you can't, in fact, take a position in, because that position would be huge in relation to the daily volume of the share. So I'll just give you an idea how this looks. And if I go back into VectorVest and I go to Unisearch, and I've pulled up our most conservative search based on our worry-free investment methodology. And it's a search that looks for shares that are above 50 pence. And the second line is that the stock's average volume, the 50-day moving average of volume, is greater in this case than 50,000 shares. This is not the worry-free is not a trading methodology. It's an investment methodology, so we're not going to be trading that much. Looking for shares that are not on AIM. It's looking for shares where the price of the share is less than the value, and the stock's recommendation is not, that double arrow means not, on a sell. So it's either on a hold or a buy. And what's very important about this search is that it, in fact, sorts all of the shares on the stock market by relative safety. So it brings those shares with the safest track record of making money to the top of the pile. And it is a very conservative search, but it's done exceptionally well. If I go back to the last confirmed up, and the last confirmed up is very conveniently marked by this green, and that was the last confirmed up. Remember, the most important thing to know is whether the market is rising or falling. Everything follows from that, and our worry-free methodology suggests that you take positions when we get a confirmed up, i.e. the longest term measure of the trend and the long of the stock market is turned up. I run the search on that particular day. Those are the shares that I get. And if I do a simple quick test of the top 10, that search has produced a 12.87% increase from the 9th of January to the 18th, well, last Friday, it'd be the 16th of March, 15th of March, should I say. The overall market is up 3.51%. So that conservative search has produced 4x times the market, 72% annualized. Long may it last. The trends in the stock market, as I speak, are still positive. So anybody within the worry-free trading methodology, following that methodology, following that process, and it is a process, would still be holding those shares. So tip number 8 of our little series, folks, is trade in liquid shares, and that will allow you to accurately define your risk. And just remember, this business is all about risk and reward. So don't be scared of risk, embrace it, manage it. And if you're trading in illiquid counters, you will not be able to manage it. I hope you've enjoyed this little video series. I found it really useful to remind myself of all of these points. Thank you very much. Bye-bye.
Thank you for taking the time to watch that presentation, but I know you're eager for more. So if you're looking for region-specific information, check out the UK and AU channels right here. Looking for more great VectorVest content? Click this video right here. If nothing else, folks, click the subscribe link right here.